So my name is James Cook. I'm one of the portfolio managers on JP Morgan Global Growth and Income Investment Trust, which from here on I'll refer to as JGGI. It's our ticker and a little easier on my tongue. So JGGI is a global unconstrained best ideas strategy. We're looking for the best 50 or so ideas across our research platform, where we cover around 2,500 stocks. So from our perspective, it makes it one of the highest conviction strategies out there on the market. Less than 3% of the stocks that we look at make the final portfolio. So there may be more concentrated strategies out there that say hold 20 stocks. But when it comes to conviction, we think this is one of the highest conviction strategies in the market. So slide number 2 gives you all the key information about our strategy. So you can see from the top left that we hold somewhere between 50 to 90 stocks at the moment. We're much closer to the 50 stock number. And we have about £2 billion of assets within the investment trust. The top right shows that we've delivered highly competitive performance numbers over the long term. So whether you look at the 1, the 3, the 5, the 10-year performance, they are all highly competitive. We have delivered a consistent premium to the net asset value since around 2016, something that's pretty rare within the investment trust universe, something that we're pretty proud of. And it's worth discussing at the bottom left. One of the key features is that we offer a 4% payout ratio, so that's 4% of the net asset value in 4 quarterly equal installments. And then behind the success of our strategy has been our breadth and depth of research. It's the resources that are available to JP Morgan Asset Management, and I'll take you through that in a little bit more detail later. So since this management team has led the strategy, we've delivered returns of around 75%, cumulative returns of around 75%, illustrated by the blue line. That's about 35% more than the broad market, illustrated by the yellow line. And it's not really just the magnitude of the performance that we're proud about, it's also the manner in which we've done that. So we've been able to deliver strong excess returns in risk on, risk off, in growth regimes and in value regimes, illustrating that our stock selection has been independent of the style regime that we're in, and I believe that makes us uniquely attractive to shareholders. So with that said, in today's presentation, I'm going to take you through a brief introduction to global equities, why I think investors should be excited by the global stock market, an introduction to our strategy, JGGI, and what we look for in a stock before we make an investment, and then finally our performance and positioning. So if we can start with why global equities, and if I think about our UK investors, 10 years ago, had our UK investors been domestically focused, had they put, say, £100 into the FTSE 100, that £100 would be worth roughly £159 today, a reasonable set of returns. However, had they considered putting that £100 into the global stock market, that £100 would be worth roughly £256 a day, illustrated by the blue line. So for those investors that are willing to look overseas, we think there's a vast number of attractive opportunities out there for you. And now, rather than looking at the broad market, instead, if we now focus on just the best 50 performing companies over the last decade, what you can see from the pie chart on the left-hand side is that the best performing companies don't come from any single region, but instead they're scattered across the world. So while the US is renowned for having some of the best media, some of the best internet, the software companies, names like Microsoft that we hold within the investment trust as its fast becoming a leader or the market leader in cloud computing, an area that we see as high growth for many years to come, and arguably having the best large language model in ChatGPT, which we think will only further improve their position within cloud computing and probably extend the growth runway. But not all the best companies in the world come from the US. Some of the best industrials in the world come from Japan, particularly in automation and within robotics. Some of the best retailers, luxury retailers, and semiconductor manufacturers come from Europe. So names like ASML, another stock that we hold within the investment trust, which has a monopoly and leading edge technology in shrinking the size of chips. So for all your new iPhones, for all the new data centers, AI, all of that requires smaller, more powerful computing, and all of that is reliant on the technology owned and sold by ASML. So with that said, I'm now going to take you through our offering, JGGI. And at a portfolio level, we have two main objectives. The first objective is to deliver key fundamental characteristics that are superior to the benchmark. So we want to give you superior quality of earnings. We want our stocks to have high barriers to entry, high barriers to profitability, so that they are not at the mercy of their competition. We want them to have strong balance sheets and resilient earnings, so that they are not at the mercy of the economic cycle. And what you can see from the blue bar is that we believe about 80% of our portfolio is in high quality businesses. That's about 30% more than the market. It's one of the highest levels we've been running at since managing the strategy. And if we were to go through an economic cycle, we think this would bode very well. We have an enormous amount of data to suggest these companies bode very well as they go through a negative earnings cycle. The second part is that we want to be able to outgrow the market. And what you can see from the green bar is that we believe our portfolio can outgrow the market at over 3% a year. That's a significant step up over and above the level of market growth. And then finally, we want these characteristics and we don't want to pay for it. So you can see from the purple bar that our portfolio spits out just as much cash as the market does. And so given that our price is relatively similar to that of the market, but we believe we have superior quality of earnings that grow faster than the market, what it implies is that we believe our portfolio has been underappreciated by the market. And then finally, just to add is that while this sounds all very easy and simplistic, the reality is it's not. So less than 2.5% of the companies that we look at can offer you all three of these characteristics. So to build a portfolio that offers you this requires an enormous amount of breadth. It means that we have to have an enormous amount of coverage, that our analysts are looking at all these stocks so that we can find companies that offer you superior quality of earnings that grow faster at a better price. Now, if we can achieve our first objective, it helps us to achieve our second objective, which is to deliver excess returns that are independent of the macro regime that we're in. So whether we're on a risk-on environment, a risk-off environment, whether we're in a growth regime or a value regime, we want our stock picking to deliver strong excess returns independent of that. So what you can see from the right-hand chart is that from 2019 to the end of 2021, we saw a growth regime. That's where the growth stocks, your internet, your media, your software companies, outperformed your value stocks. It was one of the strongest growth rallies on record. Growth outperformed by as much as 40%. And over that time period, JGGI managed to deliver over 8% excess returns above the market. Then in 2022, when we saw signs of overheating, the value stocks began to work, interest rates were picking up. So now think about your banks and your utilities beginning to perform well, illustrated by that black line coming back down. And yet again, we managed to deliver nearly another 8% excess returns above the market. Then finally, with the launch of ChatGPT back in December last year, we've been in another AI-led growth regime. And again, we've managed to deliver strong excess returns, nearly 5% returns over and above the market. So with that said, I'll now take you through how do we go from the 2,500 stocks that we look at down to the best 50 or so ideas. And for JGGI, we have a simple 3 key criteria checklist. The first is that we need to see significant valuation upside in the stock. And at the heart of our philosophy, we believe that the value of a company is driven by its long-term earnings power and the quality of its cash flows. So once our analysts have forecast the long-term earnings power, once they value the quality of those cash flows, we get an expected return. We then rank those expected returns from the most attractive down to the least, and we're naturally going to be looking to buy the companies with the highest expected returns. However, we appreciate that undervalued businesses can remain so for prolonged periods. And therefore, we also want to have clear insight into what will make the stock work. Where is our edge and where do we differ from the market? Now, insight is incredibly important because every company, even the best quality companies, will at one point have their wobbles. And if we have insight into the businesses, we'll be able to trade them better. We'll be able to understand which of those wobbles is a short-term issue that we should probably be adding to because valuations will be becoming more attractive versus those that have a long-term crack in the investment thesis that we probably need to be exiting early. But you can have all the insight into the business, you can have all the valuation upside, but if the company doesn't control its outcome, it can all be for nothing. So we're also looking for high conviction stocks. Those are stocks that do control their outcome. So coming back to it again, we want to have those high quality companies, high barriers to entry, high barriers to profitability, so that their outcome is not driven by their competition. We want them to have strong balance sheets and resilient earnings so that they're not at the mercy of the economic cycle. And we want them to have a high quality management team that's incentivized to deliver on behalf of shareholders. Once we've done that, we then go from the 2,500 companies down to the best 50 or so ideas. So behind the portfolio is a partnership between the portfolio managers and the research analyst. Here you have the global equity portfolio management team at JP Morgan. We manage 3 key strategies and over $35 billion. You can see the JGGI portfolio management team here in blue. And between Helgi, Tim, and myself, we have nearly 70 years of experience, all of which is within fundamental investing. So each of us have been managing fundamental global portfolios for over 7 years. We've been research analysts, all 3 of us have been research analysts, and Helgi has also been the global head of research as well. But the second big advantage of working within a broader network of PMs is that being a global portfolio manager, there is an enormous amount of ground that we have to cover. So I talked about that 2,500 companies. So being able to tap into Christian Pescher, who manages Global Select, to get some of his best ideas, or being able to speak to Sam Withrow, who does the global income strategy, talking about his best ideas, just allows us to cover that ground that much faster. But really behind the success of the strategy has been our stock picking success, which is driven by the breadth and depth of research. So let me take you through both those. In terms of the breadth of research, at JP Morgan, we have 80 analysts worldwide in the US, Europe, Japan, and the emerging markets. Each analyst will cover a sector within a region. So we'll have a European banks analyst, a Japanese banks analyst, an emerging markets banks analyst, and so on. And each analyst will cover roughly 30 stocks. So that gets us to an aggregate coverage of around 2,500 companies. We're making over 5,000 company interactions a year, and JP Morgan spends over $150 million on its fundamental research platform alone. That gives us an unrivaled breadth of research. But at JPM, it's also about the depth of research. So we're looking for career analysts. Those are analysts that want to spend their entire careers just researching companies. So unlike other houses where an analyst will typically be a research analyst to use it as a stepping stone to become a portfolio manager, here at JP Morgan, we want our analysts to be industry experts. So the average number of years of experience that an analyst has at JPM is around 19 years. So if you take Simon Ponce, for example, he's our European banks analyst. He has nearly 30 years of experience, all of which covering European banks. So he was there for the tech bubble in the 2000s. He was there for the 2008 financial crisis, the European sovereign crisis that followed, and then COVID. And getting his insights into navigating those markets, into finding attractively valued banks that have stable balance sheets, have been incredibly important in the alpha generation process and the numbers that you see later in the presentation. So that's the team, how we positioned for 2024. And here you can see the JGI positioning across the core investment universe. You have the high growth stocks or the high growth cohorts at the top. Your defensives are on the left and your cyclicals are on the right. And I'll make three key points. The first is that we are overweight the high growth cohorts, in particular the cyclical growth part of the market. That's your semiconductor cycle. We are overweight the defensive part of the market. We do think that there's downside risk to earnings, and we are underweight the low growth cyclical part of the market, because that's where we think earnings are most above normal and have the most downside risk. So if you think about your rate beneficiaries, that's your banks, that's your life insurance companies. These companies have been huge beneficiaries of the increase in rates that we've seen over the last 2 years. Going forward, however, we think that provisions are likely to pick up, and so there is downside risk to earnings. The same with consumer cyclicals. The consumer cycle has been a huge beneficiary of the fiscal stimulus that's come out from the US. Consumer goods have been in a big rally on the back of that. But going forward, we see the savings of the consumer having been depleted. We see credit tightening. We see oil price, even though it's come down recently, is still significantly higher than where it was 6 months ago. All of that will become a headwind to the consumer, on top of where we think earnings are, again, above normal levels. And just while we're touching on it, one of our largest underweights is to the industrial cyclical part of the market. Again, it's been a significant beneficiary of the Inflation Reduction Act in the United States, where, again, demand, we believe, is sitting above normal levels. And as we expect that at one point to roll over, earnings will have downside risks again. Again, in terms of valuations, within that low growth cyclical part of the market, they range anywhere from relatively fair value down to quite unattractive. And as I say, we think there's earnings downside risks there as well. But we want to deliver a balanced portfolio. We don't want to just give you a purely defensive portfolio. And therefore, within the cyclical arena, we find the semi-cycle the most attractive part of that part of the market. And again, you've got to think about this is a part of the market where the earnings have come down to some extent. And we believe that AI will lead to better volumes, whether that's GPUs, CPUs, or memory. We think AI means that going forward, the volume growth is most likely going to be better than what it has been in the past. This is a part of the market that has high barriers to entry. You have quality businesses here that can price for the growth. And secondly, the capital intensity of this part of the market has been incredibly high and falling. With that said, I'll now turn you to our top 10 holdings. And again, I'm just going to make 3 quick points here again. First is it's a highly concentrated, high conviction strategy. So our top 10 holdings make up over 1/3 of the entire portfolio. The second is we're playing into a broad number of attractive opportunities. So whether you look at Amazon with their increasing margin in the retail business, or as we discussed with Microsoft, which is fast becoming the market leader in cloud computing, or with MasterCard. And as you go from a cash to a cashless society, we think there's plenty of growth opportunity there, particularly within the emerging markets. And then just finally to also say that these businesses are the market leader in the industries that they operate within. They're high quality companies. So if we do see inflation running higher than expectations, we think they have the ability to price for that. So with that said, I will finish off with the performance. And again, we're proud to say that if you look at any of the time periods here, we have delivered strong excess returns over the 1, 3, 5, 10 performance, but also the power of compounding. And again, since this management team has taken over 4.5 years ago, we have delivered cumulative returns almost 35% above the market. So with that said, I just want to thank you for listening and for your time.